G'day, welcome to the Australian Property Podcast. I'm Pete Wargent from Alan Wargent Property Buyers. I'm here with Chris Bates from the Alcove Group Mortgage Specialists. Chris, how has your week been?
Oh, it's doing well, Pete. It's we're in the winter bunker, I guess you call it. Nothing too much to report on. Going on holidays in about a couple of months, so I'm excited for that. Just head down, bum up. We're already launching our website in a few weeks' time. It's obviously we did a rebrand at the start of the year, and together with that, we have to do all the other elements of that and the website, etc. And it's 6 months in the works, but we're almost there, so that's pretty exciting. What's news with you?
I've been at the cricket this week in Leeds in Yorkshire at the Headingley Cricket Ground, watching England knock off India over 5 days. I just went to day 5 actually, so fantastic day of cricket, and only £20 a ticket, so I certainly got my value for money there. News from back in Brizzy. Look, we've been starting to, unfortunately, get outbid on properties again over the past week or two. It's just seeing some big results again in the Brisbane market. I guess it's a bit self-selecting because the types of properties that we're interested in as buyer's agents, you often have other buyer's agents interested in the same properties. Even though Brisbane is a large city in terms of its geographical spread, I think often you find that the sorts of properties that tick the boxes for us are often popular with lots of other buyers. But there was a splitter block on 2 lots actually in Kedron this week that went for it was 2.2 million plus, so that was a big one. But even there was a unit up for sale in Clayfield that went to auction, and unusually for Brisbane, there were 15 registered bidders, just a normal little 2-bedroom unit. That went over 900,000, in fact, well over 900,000. And we missed out on another one. So I'd say early stages of the cycle, but we're starting to feel more urgency from buyers. I wouldn't say it's FOMO, but just a general sense that interest rates are being talked down in the media, probably heading down over the next few months. And there's still quite a shortage of housing across southeast Queensland, and that's just reflected in a bit more buyer urgency in recent weeks. Have you guys seen any more sort of urgency in terms of mortgage applications? Because as you said, normally this is a pretty quiet time of year.
First-time buyers are definitely coming more and more into the market. I don't think the media's jumped on this 5% deposit scheme yet. I'm just waiting for these articles to start filling our inboxes or the newspapers with, how that's going to change things in January. But I'd say it's just typical first-home buyers. Not much in the refi market. That's one of our stories we'll talk about today, is around pricing of home loans, which we'll talk a bit about that. But I'd say that's just pretty steady. It's unless you really need to refi, you're not doing it often for rate. But and not too many upgraders. I'd say there's more upgraders in the market this year than there was last year, but I'd say it's still a trickle. But the investors have absolutely been coming into the market. I think there's the investors that often want certainty. They're more, I'd say, risk-adverse investors. They haven't been the gung-ho ones that maybe over the last few years, even though rates are high, they still want to buy an investment property. These are ones who are like, well, actually, I'm going to stay living here. My mortgage is going to get cheaper. I think when rates get cut, that's going to push prices up. And a few clients have actually come to me without even me talking about it and saying, well, what are they thinking about buying? And they're trying to play this first home buyer movement next year. So they're trying to get ahead of that first home buyer wave and try to capture that run in prices. And it's a pretty smart play. So, in Victoria, you might buy something at, 700, 800, a good block of a house, which is one of the stories I actually sent you this morning, Pete, around, livable suburbs that are still affordable. Or you might in Sydney buy something under the 1.5. I think it's 1 million in Brisbane. So you might buy something, circa 800. And I think it's not a bad play for the investors, and they're absolutely coming back in the market. And some good inflation news this week, Pete, right? I've sort of been tracking the RBA rate and, what the expectations on that. And it's pretty much just stayed the same story the last few months, very, very, I guess not volatile, all right? So very stable. And that also brings confidence, right? So if that expectations of interest rates was really wobbling all over the place, that would make people not feel confident. How are you seeing, Pete?
Yeah, that affordable suburbs article was a good read, actually. So, Dr. Diaswati Mardiasmo, haven't caught up for lunch for a long time, actually. I'll have to give her a buzz. Said her highlighted three suburbs in Sydney were Granville, Guildford, and Chester Hill. Obviously, houses in Sydney are not cheap in any part of the city, but comparatively so. For Melbourne, the selected suburbs were St Albans, Epping and Sunshine West, with median prices in the 600s, I guess, for those suburbs. Brisbane suburbs were Inala and Slacks Creek in the south, which are traditionally, I suppose, lower socio-demographic areas with lots of sort of barely developed blocks of land in them. Launton in the north. So, I mean, generally the trend with these affordable suburbs articles is the suburbs used to be places like Bracken Ridge, and then they pushed out to Bray Park and Strathpine, and now they're going even further towards the sort of Moreton Bay part of the city. So really the very edge of what we traditionally think of as Brisbane. Yeah, I suppose, yeah, that's going to be the challenge, isn't it? If you're a first home buyer, we've still got the lending assessment buffer in place. It's how far in close to the city can you get? Can you afford a house, or do you have to go for a unit? I think in Melbourne there is some decent value for money if you're looking for units. So yes, and in terms of the macro news this week, population growth eased back to 445,000 in 2024. So I think it looks like it's going to settle in at around 400,000 going forward, which is more sustainable, but it's still a lot. It's still a city the size of nearly Canberra every year. And yeah, rumbling along in the background, of course, we've had the geopolitical news, and from one day to the next, it swings from spiking oil prices to a sort of a muted response from Iran, and then the oil price went all the way back down. I think it's one of those things you probably need to try as much as you can and look through the noise to the sort of medium and longer term. And as you said, the inflation figures this month, well, they dropped to around a 4-year low, 2.1%. So that's really excellent news for the central bank. Plenty of scope for cutting interest rates now without too much fear. I think when the monthly inflation gauge first came out, people said, well, it's not as reliable. We'll just focus on the quarterly figures. But of course, you give people stats, they're going to analyze them, and that's what they're doing. So, yeah, I think those figures were actually plenty lower than market forecasts. So that's pretty good news. Rents of sort of rental inflation, construction costs, and even things like insurance are really starting to ease now. So that suggests the June quarter will be quite soft. So yeah, I suppose from a macro point of view, that points to around 4 interest rate cuts or so over the next year in terms of market pricing. And of course, typically or historically, that's always been quite a tailwind for the housing market.
Pete, when there's been sort of, I wasn't around in the 90s when there was very high interest rates. I don't think you were either, but I just wonder when, the last few years have been quite tough for a lot of people, right? And they've been quite scary. I wonder how it's going to change the psyche or the behavior, or are we going to have like a recency bias, and that's going to often, is that going to stick around, or are we just going to go back to our long-term sort of overconfidence with the property market? I just wonder how upgraders are going to come out of this. As rates get cut, do they, jump on it and say, right, I can afford a bigger mortgage, I want a nicer home, it grows tax-free, I might as well upgrade? Or do they go, oh, I'm just so glad I didn't have a big mortgage over the last few years, or I did have a big mortgage and I don't want a bigger one. And, is there a bit of damage in terms of their confidence level to take on debt? And that well, it sounds counterintuitive. Like if people don't want to take on more debt, well, then they're going to stay in their home. And so you think that you need the upgraders to push prices up. Well, by actually just staying in their home, they're going to restrict supply. And then that keeps markets really tight if everyone just sits on their hands. I don't know, Pete, what do you think coming out of this? Obviously there's still concerns around AI and jobs and, particularly for white collar workers. Do you think that, that fear, the global fears, the fear of having, a lot of debt under higher rates, do you think that if upgraders are going to have a long time till they build confidence again?
Was it a Shakespeare quote? Drink provokes the desire but takes away the performance. I think interest rates might have done the same. I think falling interest rates will be very good for confidence, and we can already see that in the housing market surveys from Westpac and NAB and so on. But I think actually with where mortgage rates have gone to, that's constrained borrowing capacity for a lot of borrowers. And the latest APRA stats were out just recently. And mortgage arrears, okay, they're probably no higher than they were 5 years ago, but they've certainly come up a bit from the lows. So there'll be probably some forced sellers out there just as much as there'll be interested buyers. So I think just mortgage rates where they are probably constraining borrowing capacity quite a lot. Certainly a very different environment from the early 90s. As you said, I wasn't around as a participant in the housing market back then, but I can remember my dad dropping a few F-bombs when the mortgage rates were in the mid-teens. So, I think it's certainly a different environment. And I think, I suppose we've got enough stats going back over 30 years to show that when interest rate cycles have begun with the monetary easing, that's always resulted in price gains. I think that will be the same, but I think there's two things. One, we're starting from a higher base, and two, constrained borrowing capacities. That might just keep a lid on things, because even with these affordable suburbs articles, you're still talking in Sydney and Brisbane about suburbs with $1 million median house prices and higher still in Sydney. So, I think there'll be a lot of people looking for affordable options, and that might sometimes be outside the capitals. It might be townhouses. So I think in some cases, the desire might be there, but whether or not people can really borrow to get on board, that's a different question.
Yeah, I think I've been doing a lot of episodes on the elephant and even with you, Pete, and one of the stories we're going to talk about today was Cameron Kusher and the immigration. Is it worth sort of, a lot of people just sort of blame that one, that's the reason, right, why we got housing unaffordability. What's your thoughts on that, Pete? And Cameron Kusher did an article on it, right?
Well, look, it's obviously a key factor in housing demand. There's no question about that. And I think even we've seen in recent months, if you look at Canada, they at one stage had population growth of 1 million in a year. It was absolutely out of control at one stage, and they've annoyed the electorate to the extent that there's been effectively a pause on immigration or something close to it. Now, with more people actually thinking that the cycle may be at a peak, there's a lot more people selling in Canada, and the housing market's cooled right off. New Zealand has seen the same. So, it's obviously a key factor, but it's not the only one. When it comes to the housing market, there's always supply and there's always demand, and those variables tend to dovetail through the cycles. So yes, I think when you look at the internal movements, there's clearly been a lot of pressure created in places like Southeast Queensland, which has been the biggest beneficiary of interstate migration, and Western Australia tends to be the most cyclical market through the economic cycles. And at one stage they were losing people interstate, now they're gaining. So we've seen that the result on housing demand in Perth, for example. So I think it's definitely a key factor. Australia seems to be set on course for an ongoing big immigration program. So of course that gives people confidence that the demand for housing will be there. But I still think we'll see the market cycles. That hasn't gone away. What do you think?
Yeah, it's just I think a lot of people just sort of latch onto this as the reason for all the problems, but it's not as simple as that, right? If you cut immigration, what were those people doing? Were they studying? Were they working? Were they filling jobs that Australians didn't want to do? Were they adding value to our economy? Yeah, it's having impact on our rental market. Yes, they're having impact on our housing supply, but maybe they're also working in construction. Maybe they're actually helping us build more houses, and so I think a lot of people just want to blame that as the reason. But obviously in some countries like Canada, it did go off the Richter scale, right? I'm just looking at this article you sent through, Pete, from Macro Business, and it was trending at sort of 300,000-400,000 ish, and then all of a sudden it's at 1 million, or even a lot more than that. And I think that's obviously puts a big strain on the economy over there, and they've had to take action. But
I think a key difference in terms of what's happened with the economy, Canada's got an unemployment rate now of 7%. So I think the the appetite for more immigration when you've got 7% unemployment is very low. Australia, it's only 4%. So, and that's really been driven by big government spending, big infrastructure projects, lots of non-market hiring. So I think one challenge for Australia is that the private sector is going to need to step up to the plate next year. We can see in things like engineering, construction, the spending on infrastructure projects is still very high, but it's going to roll over from here. So we need that sort of a pivot towards the private sector again. But as you said, yes, at the moment there's still a lot of call for more construction workers, more skilled trades in Australia, and the unemployment rate is 4.1%. So still a very tight labour market compared to some of our peers. Where maybe the appetite for immigration has dropped off a bit. So let's run through our top 3 news stories of the week. So in our 2 cent segment, we'll run through the big 3 property news stories of the week, and also we'll cover off a bit of your listener Q&A towards the end. We've maybe got time for 3 questions or so at the end, so stick around for that. First story this week from the Australian Financial Review. Just a bit of a retrospective, really, in terms of 20 years of data, what investors can learn. Well, it's quite interesting. We tend to think that equities would be the number one performing asset class, but actually housing outperformed equity over 20 years, even on an unleveraged basis. So that's quite surprising. Normally, you'd probably say that productive businesses would deliver a higher return. But over 20 years, not the case. Actually, the top performing asset class was farmland over 20 years. So I suppose the key message or key takeaway is that sort of land appreciates. That's probably what investors will be taking away from this. Over 20 years, inflation officially was 67%. Adelaide house prices did 175%. Hobart 172%, just pipping Brisbane and Melbourne, with Canberra and Darwin lagging. In terms of the unit market, well, capital growth was lower, 133% for Hobart, 129% for Adelaide, Melbourne 109%, Brisbane 105%, so basically just doubling in those cities. And the absolute top performers, well, over 50 years, Sydney house prices 3,800%, so the long-term investors handsomely rewarded, Brisbane 3,500%. And just finally, in the industrial space in commercial property, Sydney warehouses, 260% capital growth over 20 years. So I think those zero vacancy rates during COVID, which pumped up rents, I mean, that's really delivered in the industrial space. So pretty interesting stats, Chris. What did you make of it all?
It's pretty crazy, isn't it, that land has gone up more than equities over that time frame. It just it doesn't really make sense. I don't think it should make sense. I think, companies should be growing at a faster rate than land prices. And, when you look at the ROI or return on investment of potentially buying, houses and the amount of money that you put in, back in the day, you might have put in a 20% deposit. So, you're basically putting in, 20% of the money to get 100%. And these percentages are based on a very high starting price, because you're putting a lot of money in because you're leveraging your money. And so the returns versus, say, just putting that same money into equities and only putting 20% of the mony in and then actually compounding at a lower rate is astronomical. What do you think, Pete, around? I mean, it's always exciting looking at these numbers and you go, if you had Sydney property for the last 50 years, obviously you would have done extremely well. If you had Sydney property or anywhere in the country, for the last 20 years, you would have done really well. A lot of people sort of think the day's done, though, right? And, growth rates won't continue anywhere near these rates. And what's your take on when people say that, Pete?
Yeah, I think there's probably some truth in that. I think these asset classes are quite diverse, really. So here we go. So quoting from the article, the return on Sydney and Brisbane houses over 50 years has outpaced Australian shares, excluding dividends. So don't forget, total return basis, it might be a little bit different if you include the dividends and your rent, because I think, yes, the rental income from a house is one thing, but you've got lots of sort of hidden costs of ownership. The All Ordinaries Index returned 3,120% over 50 years. Look, sometimes I think a lot of energy goes into sort of analysing what's the absolute best return that you can make on your money. But for most people, I would say just getting a good return is probably what they're looking for, much more so than trying to outperform everybody else. I think in terms of going forward, yes, I mean, well, you could have made this same argument 20 years ago that the housing market wouldn't do so well. And in some parts of the market, that's been true. But I think if you've sort of owned good quality assets, good blocks of land, they've continued delivering pretty similar returns to what they had historically. So, I think going forward, I think we're starting from some very high prices in some parts of the country, and therefore the capital growth would definitely be lower. But I think you would expect that anyway, since the introduction of inflation targeting from 1993, I think it was, in Australia. So we've got a 2 to 3% inflation target. So you wouldn't expect housing prices to be absolutely booming along if you've only got a 2 to 3% target for inflation. So maybe, I think, in nominal terms at least, you'd probably expect to see lower returns going forward. I think, the surge in farmland values is a bit surprising, but then again, I think there's possibly some headwinds there. I think some of that's driven by farms being sort of speculated on for residential property purposes, and also we've got the government looking to tax super balances over 3 million. My wife's from a farming background. I think often people look at the farm values and think, oh, wow, they've had it easy. But of course, it's a very tough sector to work in at times. So those gains can be quite hard earned. And some years you don't make any money and other years are not so bad. Pretty interesting stuff. I guess in the sort of worst performing assets of late, it's largely been office space. I think the office sort of working from home trend has taken away some of the demand for office space, and lease incomes are down, capital values. It's hard to get a read on that, but you would say they're probably lower than they were at least. So maybe lagging a bit behind over recent times.
Yeah, I mean, I think when people look at it, as they go, it's not going to double every 10 years, or it's not going to achieve, the growth it has in the past. It doesn't mean it's not going to grow. I think. And how much it grows, it maybe doesn't need to grow anywhere near the rate that was to still be a really good return on your money and still provide a lot of other benefits to you, security, stability, tax-free growth, still allowing to leverage. So, you can get a smaller return, percentage, and still make a much bigger return than, say, investing in other asset classes like shares, et cetera. So, and I think I was interested. We interviewed Martin North on The Elephant a couple of weeks ago, and I've been going on to I used to call it the lion's den, and be at the mercy of the YouTube trolls. Sometimes we get a few of those on The Elephant as well, but on this podcast as well. But I used to go on there, and all the way back in 2018, and I sort of had a contrarian view to that sort of property bear world, and I used to go on there every few months, pretty much for the last 7-8 years or whatever it is. I can't actually remember the first time, and it's interesting. His tune changed, and it's been slowly moving over the last few years. But he basically, came out with it last night and said, "Look, he got it basically, last couple of weeks ago," and said he got it wrong. And what he didn't misunderstand is just how big the government plays in the market, and when there are times that are a little bit more scary, when they come in to support the market, whether it's payment holidays on mortgages, whether it's longer loans, whether it's first-time buyer incentives, whether it's just naturally the market supporting the building industry or whatever it might be. And so I think that was an interesting take when I guess the fundamentals might not look right, multiples of incomes or how much it's gone up over the last 20, 50 years. But, there's a bigger story at play here. There's a lot of interested people in the market and pushing prices up. And so, when the property bears flip, I think that's a sure sign that, people are a bit more aware. What's story number 2, Pete?
So just a piece from The Australian. Are you paying too much on your home loan? Some analysis from CanStar found that the lowest variable rate in the market was 5.34% or 5.24% for first home buyers. The major banks are 5.9% or thereabouts. A few lenders are now offering fixed rates under 5%. But not so many borrowers are taking those sort of fixed rates at this stage in the cycle. I think it's a little bit when it comes to home loans. Chris, now you're the expert in this area, not so much myself, but I've got a trip to Edinburgh coming up, and I see sort of hotels advertising rooms for a couple of £100 a night, but I never assume that that's the best price. I just think, well, yes, but maybe if I go through a conduit or a portal or somebody who knows what they're talking about, I can probably get a better deal somewhere. And I suppose it's a bit the same with discounted and advertised rates in the mortgage market these days. I think as an individual who doesn't follow it closely, you're never really that sure if you're getting a good deal or not. A little bit like the hotel rack rates versus the best deals out there in the market. I've noticed a couple of things in the article. One was the offering of digital-only home loan products that some of the major banks are offering. I'm not sure about those. Maybe you can shed some light. Yeah, I mean, I'm just interested to know from you, really, what are people finding when they come to you? What sort of questions are they asking? What sort of tips or strategies you give them? And I suppose if I take these numbers at face value and 3 or 4 interest rate cuts priced in, well, we might even see some mortgages at 5% or below over the next year. So, what are you finding out there at the coalface?
Oh, look, there are always some lenders that are trying to get a bit of market share, or they're sort of wholesale finance, mortgage companies that are trying to basically, sell mortgages a little bit cheaper than, say, the banks do, and running on very tight margins. And they're often, maybe 10 to 15 basis points cheaper than, say, the bigger banks. And, that's good because it does bring more competition to the market. How much market share they get is very, very little, right? Often the credit policy is really tight. You need bigger deposits, 30, 40% deposits. And they don't have a lot of the benefits of, say, a big bank, apps and, access to your banking and, offset accounts and, et cetera. So, you've got to be a little bit careful on those lenders. It's not to say you don't ever use them, but you're just sometimes compromising on some areas. And, maybe a 10 or 15 basis points isn't that much when you do that percentage based on your home loan. You go, well, is it really worth it for that tiny saving? It does matter. Over 30 years, that saving could add up, but who's to say? Sometimes the banks are really competitive. I'd say they're getting more competitive than they were, say, over the last 12, 18 months, particularly on loans over $1 million. We're starting to see better and better pricing, more competition. A good rate at the moment is probably circa 5.5%, but you can definitely get under 5.5, if you've, got a decent deposit or a decent LVR and you're over $1 million, et cetera. But it's always changing. I do think the loyalty tax problem's not as big as it was a few years ago. I think it's starting to come back. I think as interest rate cuts happen, banks will take advantage of existing customers. Just naturally, they want to start putting more money back in their pocket, not your pocket, and they'll start offering bigger and bigger discounts to new customers. But you're right, Pete, there has been a bit of an explosion of these sort of digital lenders over the last few years. A lot of them haven't got traction. You can think of places like Volt. Athena's done all right, but then they end up having to go to brokers. And so they've done all right because they, basically build a broker offer rather than B2C offer. There's been a number of other options, Yard, and they haven't really been able to crack it, I guess. It's really hard to go B2C. You're trying to compete with the banks, basically marketing spend. And they are constantly advertising, their mortgages, just because it's such a big part of their business, right? And so trying to market the banks is really hard. And so the only other option is to go through brokers. The banks themselves, though, have been basically disrupting themselves, which I actually don't think is a bad thing. I think, the banks basically building a digital offer. The problem is, from the outsider looking at, and there's one bank in particular who's been gone pretty hard at this, is they're basically just cannibalizing their own back book, right? So by offering a digital loan product that's cheaper than and it's backed by the same bank, you go, well, I'll just use that. I'll save myself 20, 30 basis points. Rather than going in the bank product, I'll go into their digital product. I also know that a lot of these digital products are basically just lead gens for the banks. Their conversion rate on these digital loan products is really low. And when they don't convert, then their actual bank themselves call them and say, hey, do you want help with that loan application you did on our digital product? And then it just becomes a bank customer. So they're actually also a lead gen for these banks. They have upset the broking industry, these bank digital loan products, because while they're a competitor to brokers, banks are a big supporter of brokers. And so brokers are just a bit concerned, particularly at the way some of them have been marketed, and how they're a little bit anti-broker. And so there's one bank in particular that's been a bit more upsetting the brokers than others. So, yeah, that's the take on rates right now. I wouldn't say it's a full-on mortgage war. I'll absolutely be telling everyone on here when that is coming and when that hits. I do think it's slightly more likely to happen now than it was 6 months ago, but I still don't think it's the case. And there's always digital lenders in play. The article made a good point, though. You want to try to get your rate as close as you can to 5.5, because if there is 2 more rate cuts, which are probably expected in the next 3-4 months, you could start to see variable rates under 5%. And I do think that's a psychological hurdle for the market as well. When we start to see more and more variable rates advertised under 5%, I do think that those sort of lines in the sand, the 5 and then the 4%, will change behaviour a little bit.
From the article, the major banks' lowest variable rates, 5.59%, with NAB the outlier at 5.94%. But yes, as you said, I think you took the words out of my mouth to paraphrase Meatloaf, because I was thinking the same thing. If it feels like a mortgage rate of 4.9%, it's just in a whole different world from a mortgage of 5 point something. It's just a psychological barrier that people tend to associate with the housing market. So, yeah, watch this space. So, final story of the week, the ABC News Australia, in the business section, property prices tipped to record highs in 2026, according to Domain's latest forecast. So, tipping price rises over the next year, but with Sydney and Melbourne now set to lead the way, with price increases of about 7% respectively. It had been previously the medium-sized capitals that have been driving the housing market, the Adelaides and the Brisbanes and the Perths. Prices are still expected to rise in those markets with interest rates falling, but it looks like the big capitals coming back into the picture now with immigration ramping up again. Affordability constraints mean that unit prices are also tipped to rise. And finally, in the pain and gain report from Cotality, about 5% of properties are still reselling at a loss, despite prices at the macro level going up. Some people are still getting it wrong. These are often sort of off the plan sales, and I think as well in some cases where people got involved in crazy bidding wars during the pandemic, they're probably having a bit of buyer's remorse at the moment. So, yeah, I think, those kind of forecasts sort of broadly make sense to me as interest rates come down, but there's some affordability constraints. Sydney is expected to see the median house price rise 7% through to the end of financial year 2026, and for Melbourne, 6%. Brisbane, Perth and Adelaide are showing signs of cooling, but not nearly enough to ease the pressure on first home buyers. And then there'll be some competition for units as well as that first home buyer 5% deposit scheme kicks into gear. Chris, did you have a run through those numbers? And if so, did you agree or disagree?
The pain and gain report, it's one of my bugbears with it is that it doesn't include buy costs and sell costs. And I've been in the ear of Eliza Owen and the CoreLogic team or the Cotality team for many years saying, hey, if you really want to do this properly, just add in a 5% cost to buy and a 3% cost to sell. And those numbers will explode a lot further because the numbers of people who just have this desire to get their money back, just so they can tell people they haven't lost money on property. But the reality is they've lost a lot of time and opportunity cost. And opportunity cost is probably the most painful cost these investors never really want to understand, because it really does hurt, particularly if you look at the opportunity cost to now, but then also the opportunity cost of in the future as well. Like if you then reinvested that money for the next 20, 30 years to your retirement. And I think what it really highlights is just how often people get it wrong. I do think you're going to see this explosion of articles talking the market up over the next 6 months. And, that in itself changes sentiment. I always laugh, though, when they pick like numbers under sort of circa 10%. They always pick, 4 to 7% and things like that. And like those sort of slow growth rates it's not really how the market works. I feel like the market goes in sprints and pauses and sprints and pauses. And that's what I sort of like about, Louis Christopher and how he does his sort of forecasting is he'll do a number of scenarios. And if, scenario one might be if there's, 1% plus of cuts and unemployment stays low and inflation stays low, then we're going to see a 10 plus increase in prices. You know, if there's two cuts and unemployment starts to rise and inflation stays a little bit, toppy, then, there'll be a bit less growth. Or, and I think those scenarios is probably a better way to think about it rather than, these forecasters' numbers, because they're usually just never right.
It's the same on the downside as well. If you get three bidders at an auction, then you're going to get a fairly competitive price. But if that falls to one bidder, suddenly you've lost 10%. That seems to be the way the cycle works. It's not necessarily a smooth glide up and down. That's not how you experience it in real time. I think as well on the pain and gain report, don't forget to add in renovation costs. As somebody who's going through a reno at the moment and looking at painting a fence this week, put a couple of $100 in the budget for paint. Actually, it's going to be $1,000. Like that's the kind of overruns that a lot of people are experiencing. And those are all hidden costs of ownership and sometimes not well accounted for by owners in the market. So let's wrap up today with a few questions on the listener Q&A. So first question from Q. We're planning to sell a positively geared investment property within the next 18 months to avoid capital gains tax and fund our forever home. Would you recommend selling in spring 2025 or waiting until 2026? Funds might be tighter, but do you think the potential 2026 property boom is worth the wait? Hard to say without knowing exactly the location or property, but I suppose if you take those domain figures at face value, you might get some fairly solid capital gains, I suppose, over the next 12 to 18 months as interest rates come down. I suppose you need to factor in the time value of money, I suppose. You do need to see something to make it worth your while. And I think the first home buyer deposit scheme really kicks into gear in January. So if it was me as somebody who likes to be an opportunistic seller, I would probably wait. And in fact, full disclosure, I actually have a property I'm thinking of offloading, and I am waiting for that very reason. So that's just a unit in Sydney. So what do you reckon, Chris? Same or different?
I think I'm just sort of trying to unpick it. These are very hard to, there's a lot of things that go into decisions on what you shouldn't do. So Q, I probably wouldn't listen to our answer on this and then act on it. But anyway, it's just interesting. To avoid capital gains tax, I'm not sure how you're thinking about that. I'd be going to I'd be getting your accountant to talk to you about how that actually works. And, because if you're thinking about the 6-year rule, well, that doesn't mean that you're going to be paying capital gains tax on everything if you sell it after 6 years. So just maybe have a chat with them around that. Now, the second part was to fund your forever home. Well, that's more interesting. That to me is the big point here, because if you're trying to fund your forever home, I guess it's probably more likely to be a house, and you're probably likely to think that that's probably also going to go up. So if you wait till 2026 to make more money on this investment property, and then you're then going to go rebuy back into the market, or are you going to find that that's gone up more than your investment property? And so I think that's the big thing here is that, you should be selling this not so much to, time the sale at the perfect price. The only other interesting point is if you can keep that investment property and still buy your forever home. Now, if you can, often not the case just because of tight capacity and higher interest rates and just how much people can borrow nowadays, but and what you need to spend to buy your forever home is actually a lot more. I reckon if you can afford to keep it, I probably would maybe gamble for another 6 to 12 months and try to sell it next year. It's a tailwind, not a headwind, lower interest rates. And who's to say we don't see APRA jump in? Who's to say we don't see longer loans? There's all these other things that could also, on top of positive sentiment and rate cuts, that also give you extra kick. And you might want to try to capture that rather than selling it a little bit too early, because I'd say that the party probably starting, not ending.
Your answer was so much better than mine and much more articulate. So disregard what I said and take into account what Chris said. It also depends if you're buying into the same market, of course. Second question from Landy Andy. I'm just assessing investment grade apartments or units or flats. I'm looking in Sydney's blue chip areas at older style apartments, 1970s or older, ideally Art Deco from the 1930s. I understand the idea of maximising the land component, i.e. you're paying mostly for land and not so much for building. And in some cases, it's not that hard to find the land value being, say, 80% of the price, even using the Office of State Revenue land values in New South Wales for land tax purposes. My question is, do I buy for land value only? And does this make it a good investment? Or what other factors should I consider, e.g., good property, layout aspect, quality of street, and so on, just balancing up the different factors? I think, yes, I would say when you talk about land to asset ratio, that's more just a guide more than a hard and fast rule. I think that's particularly the case when you're buying a unit. If you're not controlling the whole block, I think, yes, if you're buying a knockdown weatherboard home, well, yes, you would really just assess what is an empty block of dirt worth, and that's a really good guide to what you should be paying. It's a bit different for the unit market. And I would also just advise just a note of caution on using sort of state government or Office for State Revenue land value figures, because they're really generated for land tax purposes and for council rates and so on, not necessarily exactly representative of what the block of land would sell for if it was vacant. So yes, you need to factor in, could the whole unit block be acquired? Yes, and if so, what's the kind of approximate land value or a value, the best value in use? That's definitely one factor. But I would also work on the assumption that the property stays as is, because if you're just buying one block, one unit in the block, you've probably got very little control over the future use. So I would say it's just one factor, but not everything. What do you reckon, Chris?
Look, if you could get a property that also has potentially one day it's really enticing for developers, I don't think it's a bad play. I think just the way that the market's shifting over the last few years with Chris Minns and changing planning zones. I mean, there's a block available in Rose Bay right now, and it's like 170 million. It's 11 homes or something that have basically combined, with the change of zoning. And they probably didn't buy those thinking there was development potential, but the zoning's changed, and all of a sudden these houses are, as they put them together, they make sense to sell it to a developer. And I think, as the cities evolve, we are going to get less and less NIMBYism. And so before, maybe there was this 6 block of units was, unlikely to get zoning changes, but now it has changed. And particularly if you look at the more aspirational parts of Sydney. So the problem is I'd want to go buy an apartment, though, that even though it's a lot good for development, it hasn't got a massive lifestyle deterrent. So, you wouldn't want to buy something on a busy road just because it's more likely to get developed there, and then gamble on that. Because if it doesn't happen, your growth's probably going to be more subdued because you've got a major drawback when you sell it one day. And unless someone else buys it with the view that it's going to get developed, I don't think that's going to get factored into your prices. And so, a small block of units, I mean, what he's kind of saying, I think you're already on the right path here, Andy, in terms of a quality asset, I believe. A small block of units, affluent, aspirational sort of suburb that, house prices are way too expensive, and you don't buy a studio or a one-bed apartment. Try to get something a 2 or a 3. 3s are really hard. They just don't really exist. But you might be able to get 2 and a sunroom or something. Try to buy one of the better ones in the block. Don't buy the sort of the dark one on the street side that's, got no parking, that's, maybe got privacy issues. Try to buy one of the better ones in the block. And something that does suit, ideally as many buyer pools as possible. So you've got singles, you've got couples with one kid or one, small child or 2 small children or, maybe one older child. And then you've got downsizers and divorcees and so, if you buy something that really a lot of people would really want, and particularly people with either, cashed up downsizers or high income families, and you buy one of the better ones in the block in an area where they're not really building anymore, because often in a lot of these premium suburbs, if they are building, they're not building similar apartments to currently what are out there. They're building 3-4 bedders, sky homes, things that are almost not that much cheaper than houses. So when you basically look at supply, you can see supply's tightening up in these because people are moving from investment. These are often owned by investors. They're now getting owned by owner-occupiers. Owner-occupiers live in them a lot longer. And so it's going to get harder and harder to buy these good apartments in these areas because they've shifted from maybe a 50-50 owner-occupier rate to maybe a 55-60, 65-70, and they're just going to keep on getting owned by owner-occupiers. So I think they're great investments.
We've had clients pull off that strategy before. I remember buying a red brick in Neutral Bay, just did a little block of 4 views of the Harbour Bridge, and didn't have it for long, and then the developer swooped and bought the whole block. I think one of the owners needed a bit of arm twisting, but and it wasn't even rezoned. It was just there was a better usage of the block when you've got harbour views. I think we did some research a few years back of where the ratio of house prices to unit prices is highest, and Centennial Park was the number 1 suburb because the median house price was over 5 million and the unit price was so-so. And there's a few of those types of suburbs around, Rose Bay and so on. Let's wrap up with the final question from Rhoda. This is one for you, Chris. What is the impact of positively geared property on borrowing capacity? So I imagine it makes a small difference, but what's the answer, Chris?
I think it's a way to think about lending is the bank looks at it and says, look, let's total up all your income. And, and then whether it's positive geared or negative, it doesn't really matter. And basically what they'll then do is say, okay, you've got all this income, you're going to pay tax on that. Some's to you, some's to your partner. And then they go, this is how much income you got. Now they go, well, what are your expenses? What other debts have you got? And, they'll look at your car loan, your HECS and, your personal loan, if you've got any of those. Ideally, you don't want any of those. So they look at your mortgages and they say, well, I know rates are X%, but we need to put a buffer on that. And whether you're paying principal and interest or interest only, et cetera, some banks will look at this a little bit different. So I wouldn't be too concerned about going, is it positive geared or negative geared from you as a individual? I don't think it really makes much difference, right? What really matters is just how much income you've got and how much debt you've got. And then also there's this like minimum living expenses that you have to, even if you're spending less than that, the bank's going to use that minimum. And that's called something called a HEM. And so, selling a property because it goes positive geared isn't the reason to sell it, The reason you would sell it is because it's not going to really grow for you long term. And there's better use of that equity within that property, whether it's to, pay off your home loan and then reborrow and buy another investment, or, you want to put that into equities or whatever it might be. And so, there is a belief, though, that if you just buy a positive geared property, you can just keep on buying more and more. That's just not the case because banks don't use current interest rates, and you're never going to be getting a, 3% above the 5% or 6% interest rates, 9% yields. And there's a lot of spruiking going on right now all over YouTube around buying in trusts and unlimited borrowing capacity. It's all BS, to be honest. And so be really careful falling for that because a lot of people are jumping on that and it's not actually true. And so just be really careful falling for those. People just basically producing content that's very clickbaity.
Yeah, there's always sort of loopholes that people talk about, but some of them are pushing the very boundaries of what's acceptable in a lot of cases, actually. So that's about it for this week. Thanks for the answers there, Chris. Come and join us on the Rask Community Forum, community.rask.com.au. Loads of great chat and content there. If you've got questions for us, send them in. For our Q&A, always happy to cover whatever you want us to talk about. Quite a weekend for me, Chris, just going to see my old man. So not much happening here, just a quiet lunch. What about for yourself?
My sister's finally moving into her place she just renovated in the eastern suburbs of Sydney. So it's a house. And like you said before, they're around the paint, Pete. It's a lot more expensive than she thought going into it, but she's finally got the keys. And I'm looking forward to sort of seeing the finished product on Sunday and helping her move in. And she happens to be 26 weeks pregnant at the same time. So, she's got a bit going on. But look forward to seeing her on the weekend. Thanks so much, Pete. Look forward to chatting next week, and happy Sunday, everyone.
Cheers. Thanks, everyone.
Thanks for watching this episode of the podcast. If you want to hear more from us, you can get daily videos and podcasts on Rask's YouTube channel. Or if you want to enroll in a free course on investing, property, business, money, you name it, you can join over 34,000 other students and enroll in a free course on the Rask website. Simply head to www.rask.com.au and follow the prompts. Thanks for watching this Rask podcast.